Benson here, and today I want to talk to you about how to analyze a tokenized real estate deal. Well, the answer to that is the same way you analyze any real estate investment deal that you're looking at being involved with. And for me, there's really 7 crucial steps that you'll want to consider when you're looking at what type of real estate investment you may want to invest in. And the first one, which I believe is the most important, is to take a look at the sponsor that you're looking at investing with. This is the person who is putting the deal together. Often they're called a syndicator or a general partner, but they're the ones who typically put the deal under contract. They are the ones that are normally going to be responsible for the operations and overseeing the management company and also putting together the funding to do the deal. They're the ones offering the real estate investment to you. So you really want to make sure that the sponsor you're looking to invest with is qualified for the type of investment project that they're doing. So what's their experience level? What's their track record? Those are things to take a look at. And I really think that that is the number one most important thing to consider, because you can have a great property in a great area with a very poor operator or sponsor and have it not do well. You could also have a very mediocre property in a mediocre area with an excellent seasoned professional sponsor or syndicator who can make it a successful investment. So that's number one to take a look at. Number two is the old location. And this is critical. The reason is because real estate is about supply and demand. And if we're talking, say, apartment buildings or storage facility units or even office space, it's all about the demand for that property, the demand for the housing units, the demand for the storage units, or the demand for the office or retail space. So you could have the most gorgeous building and property around. But if it's in a city and it's got a population of 1,500 people, then that's going to be a high risk level for the demand for that real estate. So even though the building could be wonderful and the sponsor could be good, that location is really, really important. Now, normally a seasoned sponsor understands location as well as anybody, so you don't run into that problem a whole lot, but you do need to take a look, right? Same difference, though, on the other side of the coin, if you see a property that maybe you wouldn't live there yourself, or perhaps you wouldn't run your business out of there, it may be located in the heart of the hustle and bustle, in the middle of a tech hub, for example, something like that, where there is a lot of demand for that space. And therefore, the location really supports the value and reduces the risk level for that real estate. So I think paying attention to that is important. And then on more of a macro, just in general, you of course want to take a look at where the real estate is located and see, is there inward migration to that area, to that city, to that town? Or is there outward migration to that city, to that town? Those are just trends that really in the real estate world are kind of common sense. But if you're not used to investing in real estate investments, maybe that's not something that you're used to taking a look at. But one way to do that is you can get on, U-Haul or any of these moving companies and see where the trend is for one-way trips for their moving trucks. Are they coming in? Or are they going out? And obviously the jobs in the area, commerce in the area, businesses in the area, those are all things that are related to the location that you really want to look at and pay attention to, because that tells you how much upside the property may have. And it also tells you how likely financial projections are going to be. On the other side of the coin here, or token, pun intended, is if it is in a location that only has one major employer. I'm going to pick on Youngstown, Ohio. and they had a mine there that was shut down at one point in time, and it absolutely collapsed the local economy. And so properties were selling on eBay for, $1,000, $2,000. We've seen similar things in the past in Detroit, right, where you have a single industry or a single employer, and something happens to that, and it creates a lot of risk. So those are the things to consider when we're talking about location. The third thing to consider in these real estate investment deals is, of course, the financials. And when I'm talking financials, I'm talking about the actual financials and performance, as well as the pro forma financials and performance. So the actual financials and performance are going to have to do with like the current rent roll, the current expenses, what the current net operating income is. And then a pro forma is going to be what it could be. What can you increase the income, say the rent level, to in the property? Or what can you decrease the expenses down to? Those are things that you really want to take a look at. And so there normally is two sets of numbers. You're going to have your actual numbers and your pro forma numbers. Now, in real estate and real estate investment, it's very common that somebody maybe gets a good deal based on the actual numbers, or maybe even something that looks okay or possibly even below average. But the ability to meet the pro forma, meaning these projections, is very, very strong, is very good, very high. And then the building or the real estate portfolio would have excellent returns. So those are the things we want to look at: is what are the actual numbers? How's it performing today? Net operating income. And where can they get that, the sponsor or the general partner, where can they get that net operating income to? So let's talk about net operating income for a minute, because that's very, very important in putting a value on the real estate. So the first thing to know is, what is net operating income? Net operating income is the total income minus the expenses, and that's before any debt or debt service. So you have the total income minus the expenses is the net operating income. And then, of course, if you're digging into the financials, you'll want to understand what underlying debt may be there, what their debt service or their debt payment is, and what that picture looks like. But the way commercial real estate buildings are valued is typically based on the net operating income. How much net operating income can this building make? So as a professional real estate investor, your sponsor, your syndicator, their job will be to increase that net operating income as much as possible by increasing the revenue and decreasing the expenses to produce that net operating income. So always take a look at the financials and what's going on there, which leads us to our next, number 4 thing to take a look at when analyzing these deals, and that's the strategy. What is the investment strategy involved to increase that net operating income? If they're just hoping on inflation, for example, or just natural rises in the market and it's not performing well today, that's not a very good strategy. Or if their strategy is to have the highest rents in town without bringing that same level of value, that obviously wouldn't be a good strategy either. But maybe perhaps the building is underperforming. It's not operating as well as it could be. So the rents are, below average maybe. But they can go in, manage it better, maybe make improvements to the building on the inside, outside, or both, increase those rents, which increases the revenue. And all things considered, normally that increases in net operating income. Because when you do things like, say, rent raises, or you add value or features to a property that increase the revenue, normally the expenses don't follow. You may get a small uptick in the expenses, but most of the time, once you make those capital improvements, you're going to have a much higher revenue number with a similar expense number. So, what is their strategy for doing that? And does that make sense to you, right? If their strategy is to buy a storage facility and it's currently operating at a 70% occupancy rate, what's the strategy to get that to say a 85% occupancy rate? And what's the reason that it's not there now? If it's simply they expect to just be able to fill it up, again, not a very strong strategy. If it's the fact that the facility is only open, 50% of the time, and the lighting and the security is not good, and they intend to put more automation into the facility so somebody can rent 24/7, 365, they add lighting, they add security, those types of things, then normally that's going to attract more tenants as well as allow them to increase the rental revenue. So that is a good strategy. So strategy on getting from that actual to the pro forma is something you definitely want to take a look at. All right, let's go to number 5. So number 5 is you want to take a look at what the actual condition of the property is. It may be the condition of the actual land itself and what phase of the development is that land in. Meaning, do they already have all the permits, all the utilities? Have those permits for the build out been signed off? There's kind of two ends of the spectrum. One end of the spectrum would be it's just raw land and they intend to do all these things in the development stage. That's going to be one type of consideration in the investment, all the way to the other end of new development where they have an occupancy certificate and they're ready to have people rent it and move in. And there's just a whole spectrum in the middle, including maybe parts of the building are or parts of the project are completed and people are using it, renting it, that type of thing, and some still are not. But in a new development project, you want to understand what part of the development that's in and make sure that from a risk level, they know they're going to be able to complete the project all the way through. For example, if they are just at the raw land phase, is it the proper zoning for the project that they want to do? If no, that project may have a higher risk level because what if they don't get the zoning changed that they need? If they do or they did just get the zoning change, that may be a great opportunity for development with some nice profit potential. And that spectrum goes all the way up to building permits for the type of building that they want to build, and making sure that this development budget is on point. When we go back to actual and pro forma, this is really mostly going to have pro forma numbers in it. If it's a new development, you just want to make sure that what they're budgeting for cost of that development lines up with what makes sense. So, your due diligence on that will be up to you. Again, a great sponsor, a general partner, will really be able to shed some light on that and give you some reference material so you can be informed in the type of decision making when investing. That brings us to number 6 in analyzing a real estate investment deal and talking about new development. So a different kind of condition for the real estate development. Now, there's a pretty wide spectrum when you're talking about development projects. It can be the raw land itself, all the way up to the finished building that has a certificate of occupancy and tenants are ready to move in. And each of those phases of development will have different risk levels that you'll want to consider. For example, if it's just the raw land itself, that may carry a higher risk level and you may want a higher return on something like that depending on the previous 5 or 6 items we just went through. Meaning this, let's say they want to build an apartment building, but it's not zoned for that quite yet. Well, there's a higher risk level in that investment because they haven't got the zoning approved. And maybe the general partner or the sponsor has a solid plan and they know it will get approved and they'll be able to share that with you. But you'll want to do that due diligence because there is always the risk that the land does not get the zoning change that it was approved for, right? To where on the other end of the spectrum with the certificate of occupancy, they're already done. And there's all sorts of different phases of the project in the middle. So if it does have the proper zoning, are the utilities in? Are the parcels separated if they need to be separated? Are there building permits that are done? Are there all the environmental surveys and things like that? Are all these things complete? And you should be privy to that information. That should be shared with you in the pitch deck. But you'll want to be able to understand what phase of, construction or development really that land or that project is in and what is left to be done. Because when you understand what's left to be done, let's say they need to build the entire building, do they have the proper budget to be able to do that? And it's just a phase of due diligence that you'll want to take a look at with new developments. All right, that brings us to our final factor in how to analyze a tokenized real estate deal, or really any real estate deal. Number 7, and that is the return on investment, right? I actually put this at the bottom because people get so caught up in the return on investment and just look at those returns. But not all real estate investment opportunities are created equal. We just went through 6 different factors that can really change what the return on investment means. Let me just give you a quick example. Let's say you're talking about a 100-year-old building on the outskirts of town that's in average condition at best, and they say, hey, that's got, an 8% cap rate, 8% capitalization rate. We'll just oversimplify it and say that's a return on investment. Let's say there's another building that's brand new in one of the most popular neighborhoods and has some, local food chains and haircut chains and maybe some apartments that are already rented on top of it. And that one's producing a 6.5% cap rate or 6.5% return, to oversimplify it. What investment sounds more likely to actually hit that return? Well, for me, it's probably the new building. Even though it's projecting a little bit lower return, they're not going to have a whole lot of repair and maintenance in there. They're going to have high demand based on the location. And so their projections are probably pretty accurate with an experienced syndicator or GP. To where the older building, and there's nothing wrong with the older buildings. I invest in a lot of them myself, but those other factors we mentioned in this video need to line up. But if they're projecting 8%, what are the chances that it needs a new roof when that wasn't expected? That they have a much higher turnover rate in the tenant base, or there's going to be more capital expenditure into that. It's a more management intensive property. That's why the return needs to be higher. If they do a great job and they hit the 8%, you are going to be better off with that deal, right? But from a risk standpoint, you may consider the 6.5% projected return because you might think that that is more likely to hit that. There's not a right or wrong answer here. There's a reason that the return is higher on the older building, right? And if all goes well, then you would have a higher return on that building. I just want to point out the difference on return on investment. So we can break down return on investment a little bit more for when you're analyzing these, because I know that's going to be the first thing that sticks out is what's the ROI or the RRR or the C on C. Let's talk about what these are. Uh, the first one I want to talk about is cash on cash or cash on cash return. That the project hopefully at some point will deliver a good cash return. Now, again, some projects are going to cash flow from day one, and some projects are going to take either capital expenditure to bring them up to par or their development projects, so they may not cash flow day one. So cash on cash return is not the only metric to look at, right? Because even though it may cash flow day one, there may be a lot more upside and a redevelopment or repositioning project or a new development project than one that's just kind of sitting there kicking off a general cash on cash return. However, cash flow can be king. So it is important to take a look at what those cash on cash returns are. The other type of return is, of course, an equity return. An equity return would be if you were to sell your real estate tokens, or in the old days, you would have to sell the whole property or maybe do a cash out refi or something like that to be able to access your equity in there. But since we're talking about real estate tokenization, that would be what the net equity is if you sell your real estate token. So if you bought it for $1 and sold it for $1.50, you would obviously make 50 cents equity on that, right? And so that's what we're talking about with the equity. So that's the second factor that goes into looking at return on investment. You'll hear the term IRR a lot, and that means internal rate of return. And that's a metric that combines the cash flow with that net equity over a projected period of time that the syndicator or the sponsor is going to hold it. How long the GP will hold that property before selling or refinancing, and what type of internal rate of return that you can expect. Now, those of you that are real estate investment professionals may be used to using IRR, but I really actually like an annualized return on investment. For me, it's a little bit more straightforward. And when I talk to investors that don't have a ton of real estate investment experience, you can actually calculate this one on your own, to where IRR, you probably are going to need a special calculator or spreadsheet or something like that. And the annualized return on investment is simply this: what was the net cash flow you received plus the net equity if you were to do a disposition or sell it, let's say, like the real estate token example. What's the combination of those two divided by the exact amount of time it was held if you were to sell it, right? So that's just cash flow plus equity divided by the amount of time you held it, and that's what an annualized return on investment is. So when we look at our returns, we're going to factor in the other items we went through in this video, the previous 6, but you really want to hone in on your cash flow or cash on cash return, the equity position you're going to have, which could just be net equity, or you can factor that in with the IRR. The tax benefits. Now, this is real estate, right? And because real estate tokens are actual ownership, you're going to have tax benefits in most of these projects. And that may play into what your net returns are or how you look at that. That's something to really consider. But of course, consult your tax professional. Everybody has different tax situations. So, and the last one is, in real estate tokens, you can actually build in perks. So there's some hospitality projects, for example, that will build in certain perks for the investors that buy that token. And I think you'll see that in a variety of projects. So there we go. How do you analyze a tokenized real estate investment deal? There's 7 major areas to take a look at. If you do your due diligence in those 7 areas, then you're going to be able to make an informed decision to help you build wealth through real estate and achieve freedom through cash flow.